Welcome to our exploration of behavioral economics frameworks. Behavioral economics is a fascinating field that blends psychology and economics to better understand how people make decisions. Unlike traditional economics, which assumes rational actors, behavioral economics recognizes that humans are often irrational, influenced by biases, emotions, and social factors. In this video, we'll walk through key frameworks that help explain why we make the choices we do and how these insights are used in real-world scenarios. Let's dive in and discover how behavioral economics reshapes our understanding of decision-making. Traditional economics assumes that people act rationally, always seeking to maximize their utility. However, behavioral economics challenges this notion by showing that people often make decisions that are not in their best interest. This irrational behavior can be driven by cognitive biases, emotions, and social influences. Understanding the difference between rational and irrational behavior is fundamental to behavioral economics. By recognizing these patterns, economists can better predict real-world outcomes and design policies that account for human nature. One of the core frameworks in behavioral economics is the concept of heuristics and biases. Heuristics are mental shortcuts that help us make decisions quickly, but they can also lead to systematic errors or biases. For example, the availability heuristic makes us overestimate the likelihood of events that are easily recalled, while the anchoring bias causes us to rely too heavily on the first piece of information we receive. These biases shape our choices in subtle but powerful ways, often leading us away from optimal decisions. Prospect theory, developed by Daniel Kahneman and Amos Tversky, is a cornerstone of behavioral economics. It explains how people value gains and losses differently, often exhibiting loss aversion. According to prospect theory, losses feel more painful than equivalent gains feel pleasurable. This framework helps explain why people might avoid risks, even when the odds are in their favor, and why they sometimes make choices that defy traditional economic logic. Loss aversion is a powerful concept within prospect theory. It describes our tendency to prefer avoiding losses over acquiring gains. For example, losing $100 feels much worse than the pleasure of gaining $100. This bias can influence everything from investment decisions to everyday purchases. Understanding loss aversion helps economists and marketers design better products and policies that align with human psychology. Endowment effect is another key framework in behavioral economics. It refers to the tendency for people to value things more highly simply because they own them. For example, you might demand a higher price to sell an item than you would be willing to pay to buy it. This effect can lead to irrational decision-making in markets and negotiations, as people overvalue their possessions. Framing effect describes how the way information is presented can influence our decisions. For example, people may react differently to a scenario described as a 90% success rate versus a 10% failure rate, even though both statements mean the same thing. This framework highlights the importance of context and wording in shaping choices, and is widely used in marketing, politics, and policymaking. Anchoring bias is a cognitive bias where people rely too heavily on the first piece of information they receive when making decisions. For example, if you see a product priced at $100 and then see it discounted to $70, the original price anchors your perception of value. This bias can affect negotiations, pricing strategies, and even everyday decision-making. Availability heuristic is a mental shortcut that leads people to judge the likelihood of events based on how easily examples come to mind. For instance, after hearing about a plane crash, people may overestimate the risk of flying. This heuristic can distort our perception of risk and probability, influencing decisions in ways that are not always rational. Mental accounting refers to the way people categorize and treat money differently depending on its source or intended use. For example, someone might splurge with a tax refund but be frugal with their paycheck. This framework helps explain why people sometimes make inconsistent financial decisions and how marketers can leverage these tendencies. Hyperbolic discounting is a framework that explains why people tend to prefer immediate rewards over future ones, even when waiting would yield a better outcome. This tendency can lead to procrastination, poor savings habits, and impulsive purchases. Understanding hyperbolic discounting helps economists design interventions that encourage better long-term decision-making. Status quo bias is the tendency to prefer things to stay the same rather than change. This bias can lead people to stick with default options, avoid switching providers, or resist new policies. Recognizing status quo bias is important for designing effective interventions and encouraging positive change. Social proof is a framework that describes how people look to others when making decisions, especially in uncertain situations. For example, if many people are buying a product, others are more likely to follow suit. Social proof is widely used in marketing, reviews, and social media to influence behavior. The default effect refers to the tendency for people to stick with preset options. For example, if a company automatically enrolls employees in a retirement plan, most will stay enrolled. This framework is powerful for policy design, as setting beneficial defaults can improve outcomes without requiring active choices. The sunk cost fallacy is the tendency to continue investing in something because of past investments, even when it no longer makes sense. For example, people may keep watching a bad movie because they've already paid for the ticket. This bias can lead to poor decision-making and wasted resources. Choice architecture is the design of environments that influence decision-making. By structuring choices in certain ways, policymakers and businesses can nudge people toward better outcomes. Examples include arranging healthy foods at eye level or simplifying enrollment processes. This framework is central to behavioral economics interventions. Nudge theory builds on choice architecture, suggesting that small changes in the environment can nudge people toward better decisions without restricting their freedom. For example, automatic enrollment in savings plans or reminders to exercise are nudges that improve behavior. This theory has been widely adopted in public policy and business. Time inconsistency describes how people's preferences change over time, often leading to choices that conflict with their long-term goals. For example, someone may plan to save money but later spend impulsively. This framework helps explain procrastination and challenges in self-control. Overconfidence bias is the tendency for people to overestimate their abilities or knowledge. This can lead to risky decisions, such as overtrading in financial markets or underestimating challenges. Recognizing overconfidence bias is important for improving decision-making and avoiding costly mistakes. Confirmation bias is the tendency to seek out information that confirms our existing beliefs while ignoring contradictory evidence. This bias can reinforce misconceptions and hinder objective decision-making. Understanding confirmation bias is crucial for improving critical thinking and avoiding errors. The recency effect is the tendency to remember and emphasize recent events more than earlier ones. This can influence decisions, such as overreacting to recent market trends or news. Recognizing the recency effect helps people make more balanced and informed choices. The scarcity principle states that people place higher value on things that are scarce or limited. For example, limited-time offers or exclusive products can drive demand. This principle is widely used in marketing and sales to influence consumer behavior. The decoy effect occurs when the presence of a third option makes one of the other options more attractive. For example, adding a high-priced item can make a mid-priced item seem like a better deal. This framework is used in pricing strategies to guide consumer choices. Regret aversion is the tendency to avoid actions that might lead to regret. People may stick with safe choices or avoid making decisions altogether to minimize potential regret. This bias can impact investment, career, and personal decisions, often leading to missed opportunities. Reference dependence is the idea that people evaluate outcomes relative to a reference point, rather than in absolute terms. For example, a salary increase feels good only if it's higher than peers. This framework helps explain satisfaction, motivation, and competition. Risk aversion describes the tendency to prefer certainty over uncertainty, even when the expected value is higher for risky options. This bias influences investment, insurance, and everyday decisions. Understanding risk aversion helps design products and policies that match people's comfort levels. Behavioral economics also considers social preferences like altruism and fairness. People often make choices that benefit others or uphold fairness, even at a personal cost. These preferences influence everything from charitable giving to workplace dynamics and policy design. Behavioral interventions use insights from behavioral economics to improve outcomes. Examples include reminders, incentives, and default options that encourage healthier, smarter, or more productive behaviors. These interventions are increasingly used in public policy, health, and finance. Behavioral economics frameworks are widely applied in business. Companies use these insights to design better products, pricing strategies, and marketing campaigns. By understanding how consumers think and act, businesses can create more effective solutions and drive growth. Summary: behavioral economics frameworks provide powerful tools for understanding and influencing human behavior. From heuristics and biases to nudge theory and choice architecture, these concepts reshape economics, business, and policy. As research continues, new frameworks and applications will emerge, offering even deeper insights into decision-making. Thank you for joining us on this journey through behavioral economics. Stay curious and keep exploring how these frameworks impact your daily life.